May was an eventful month for debt markets as elevated crude prices, persistent inflation concerns, currency pressures, and global rate uncertainty influenced bond yields and investor sentiments. While liquidity conditions remained supportive, external risks continued to shape market expectations. As we step into June, attention shifts to inflation trends, central bank actions, and global yield movements, which could play an important role in deciding the direction for debt markets. To help us understand what this means for debt markets in June, we have with us Mr. Abhishek Bisen, Head of Fixed Income at Kotak Mahindra Asset Management Company Limited. Welcome to the show, sir.
Hi, good morning.
So, May saw a mix of global uncertainties and domestic factors impacting yields, right? How would you describe the current debt market environment as we enter June?
So, well, as you rightly said, we saw a reasonable amount of volatility. So, we are clearly in uncertain times, and volatility is the order of the day. So, when we enter such kind of situation, any financial asset class typically tries to be conservative, or you go in one side of extreme. So, which is what has made the fixed income markets to discount probably more than what probably RBI can deliver in terms of tightening measures in the monetary policy.
So, crude prices remained elevated and kept inflation in focus, right? How should investors read inflation outlook from here on?
Well, that's a tricky one, and all the investors who are listening to this show must understand that the crude oil prices, which has moved up almost from $70 a barrel to 100 plus for almost 3 months now, that almost means almost 50% prices have gone up in the international markets. And if you just look at the retail prices, they've barely gone up by 5 to 10%, right? So that means that there is significant amount of inflationary pressures on the economy while you are not feeling the same. That means someone is doing the heavy lifting, which is at this point in time the government. So a good amount of savings from your economy has gone down to the international markets. If situation recedes from here on, probably we'll be able to manage it somehow with very minimal amount of impact. But if this sustains for a long period of time, then good amount of damage probably could be done on your saving account, because prices will be passed on to you directly or indirectly. That will mean that your discretionary expenditures will take a hit. And effectively, it means that we will have some degree of slowdown in terms of economic growth.
So, global central banks have remained cautious so far. What do global developments signal at debt market going ahead?
Well, we had a recent event of COVID where central banks globally got it wrong in terms of assessment on inflation, right? So this time around, we have again a similar kind of situation in terms of demand supply shocks, etc. So central banks are likely to remain cautious and probably, as you say, that once bitten, twice shy. So probably they may, if situation continues like this, they may go in a different direction at this point in time. So they would not like to take a second chance. Which effectively means that a world will be a lot slower economy than what markets were thinking, let's say 3 months back. So that means fixed income asset class probably will be one of the best return generator for an investor.
Now, the upcoming RBI policy is a key event in June that we are looking forward to, right? What are the key expectations from RBI at this stage?
See, markets typically will react on global developments, right? So global developments are indicating that given what is happening to the crude oil, which is one of the key ingredients for inflation, that RBI should tighten at this point in time. But the key assumption is that situation is likely to remain the same. And whenever there are supply side shocks, monetary policy is the least effective. So having said that, while RBI is in a wait and watch mode, that probably things may settle down sooner and we will be able to get away with a small amount of damage. So RBI may not be able to act on this point, but there are other risks such as current account, which RBI has to tackle, and the currency front also we are having some amount of challenges. So we may have to take all kind of measures, small, so that on a holistic basis we are able to tackle this situation and convert this threat in an opportunity for global investors and as well as the domestic investors.
So yields have moved within a narrow range despite volatility, right? What could drive the next meaningful move in interest rates?
Well, it's difficult to say because we are in uncertain times that which side could be a meaningful move. As I said, markets are discounting fair amount of tightening from the central bank. Like if you look at the shorter end of the curve, especially on the corporate bonds, there are 1 to 3 year assets almost trading close to 8% mark. At the same time, if you look at the repo, which is at around 5 quarter, so we have seen the repo at let's say 6 quarter or 6 half also. Then also they were not trading the 1 year assets were not trading at close to 8%. So it is clearly discounting that kind of tightening going forward, which makes these assets fairly attractive, especially on the shorter end. If you look at the longer end, that the same story prevails. At the same time, markets are discounting a fair amount of tightening, which makes them attractive. But we are in uncertain time. If situation persists for in a similar direction or worsens due to some factors, so it can create volatility and the yields may go higher from the current level as well. But having said that, if you remain on the shorter end, the maturities come very quickly and therefore your returns are protected. You need to have patience and be on the shorter end in such uncertain times. But if you are a long-term investor, you can choose the long end as well.
So liquidity has stabilized markets so far, right? How important is liquidity support for debt markets right now?
See, liquidity is like an oxygen to your body, right? So it's the liquidity which takes care of the entire economic growth and the functioning of the markets. If you constrain liquidity as a factor in the market, it has a disproportionate amount of impact on the asset prices. So far, we have been in a reasonable amount of liquidity situation, but the liquidity was constrained or skewed in in a very narrow domain. So, which made the curve fairly steep. Now, what we need to ensure is that liquidity is spread out in the various points of the curve from the RBI in terms of operation twist or whatever they may deem fit, so that we can have a slightly a flatter curve going forward, which is good in such times for the investment perspective.
So, in such an environment, choosing where to invest becomes really important, right? How should investors approach debt investments at this stage?
See, if you talk in terms of asset class, asset allocation, one needs stability in the portfolio because there is reasonable amount of volatility across commodities, across equities, and any other asset classes, right? So, if you want fixed income to stabilize your portfolio, you have to be on the shorter end. Well, shorter end is also volatile, but relatively very little volatile. And if you are able to stay for 6 months to 1 year, the volatility will not be even felt. But having said that, if you want to be take this as an opportunity to invest for long term, then definitely you need to choose a longer end of the curve or dynamic or gilt funds which offer a higher duration. Therefore, you need to choose that. That is also pricing in reasonable amount of risks going forward, but that is going to remain volatile. You need to just volatility is your friend. You can keep doing steps. You can taking small steps. Then create a portfolio with a reasonable amount of cost. Don't be in a hurry to chase markets, and you're going to create a good portfolio for investment for next couple of years.
Now, with uncertainty still present, investor focus on balancing risk and stability, right? What, according to you, are relatively stable opportunities within debt, and what would be your advice to the investors to remain focused and disciplined?
Again, on similar lines, don't miss on the asset allocations. fixed income is one of the key part in such times when everything is uncertain. You need to have some amount of certainty and keep your powder dry. Markets are attractive in terms of valuation. Therefore, conservative investors should remain on the shorter end. And whenever the opportunities are there in the equity market, they can switch on to because largely you see people using fixed income as a parking space for the investments in equities. But probably for the near future, equities may not be able to compete with debt in terms of total returns on a risk reward basis. If the debt markets are giving 8, then if equities are giving 13-14%, then it is kind of balanced. But if debt markets are giving 8 and equities are also giving 8 to 10% or maybe lower, then definitely debt market wins. So you need to be aware of this kind of situation and make sure that your asset allocation is in line with this thought process.
So, several macro factors still remain in play right now. What are the key triggers that investors should track for debt markets in June?
Well, that's a very good question. See, markets are forward-looking, and a lot of events are in the prices already. So it will be difficult to do one-on-one correlation. However, in the month of June, there is only a single factor with the markets, be it equity, be it debt, should track is when is the truce going to happen? When is the deal going to happen with the US and Iran? But the issue is we will only know these things once the deal is announced and a couple of months have passed by because of the past where deal gets announced and effectively it doesn't materialize, right? Apart from that, we also need to see how RBI is looking at these events as of now because we have monetary policy. And at the same time, people have almost ignored monsoon, which is going to have a significant amount of weightages on what RBI is going to think and act on rates because we have forecast of around 90% long-term average in terms of monsoon. And the summers have been very, very hot, which is going to have an impact on the overall food supplies going forward.
Thank you so much, Mr. Abhishek, for joining us and sharing your insights on the evolving debt market landscape.
Thank you.
We hope this discussion helps our investors navigate June with more clarity amid dynamic environment. For more such conversations, stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.